Hello everyone, I hope everyone is doing well. So today we'll be doing a modeling walkthrough on the company Duckhorn, which is the ticker Napa. It is a wine portfolio out here in Napa, California, where I'm from. And the whole idea of this is to give you guys a better understanding of how we walk through and how we build out a financial model from start to finish. With that being said, I have done some of the formatting and entered in historicals ahead of time to hopefully expedite this process. Before we really get into the model itself, I want to touch on a few things about my overall process. So, um, what I like to do with every single company is have some sort of boilerplate or research notes giving me a better sense of the company itself that I can reference to in the individual model. So what I'll do is I'll have my SEC filings as well as, for this company it IPO'd in 2021. The main reference in this point is the S1. So I'll take notes on all the fundamental drivers of the company, as well as over here I'll note all of the information metrics and certain data points that I want to look out for as I go through these filings, and I'll have equity research. Unfortunately, I don't have tons of equity research on this company, but just enough to really get a good understanding of some of the main arguments behind it. And I'll preface this with we aren't going to be modeling this thing out to um, shall I say, have a better sense of kind of out of consensus views. This is going to be more along the lines of modeling out consensus and trying to give you guys the best understanding of how we build out a model and how we go about really breaking down a company's unit economics and the operational facets and levers of the company itself. So before we get into the model, let's go through what they do, as well as the information that they give us. The S1 was a great place to start. I will say that I don't have infinite notes. Usually, this kind of SEC filings in S1, right? I'll go through all of the 10Ks, 10Qs, 8Ks that are important, as well as try to absorb as much information through equity research, company filings, road shows, investor relations, earnings call transcripts, really digest everything that I possibly can, all the information that they've given us. So let's get into this. Um, so what Napa does is they have a variety of wine portfolios that they own. They sell wine in 50 states, pricing from anywhere between $20 to $200 per bottle. They like to participate or highlight the kind of luxury segment of wine, which they denote as anywhere above $15 or higher per bottle. Um, they're somewhat well known within the industry. Obviously, Napa is kind of your premier area in the US for wine. They have multiple different distribution channels. They consider themselves to be omni-channel, so they have your direct to consumer as well as through distributors across 50 states. And they also have kind of in-person tastings to try to build up that um, customer loyalty and tasting rooms and a wine club as well to go along with that. So like we stated earlier, their target market is the luxury wine space, and the majority of the wine is sold in the US. They have over 500 retail accounts within that space. Um, a large part of this company is, yes, trying to understand the company itself, but also the greater facets and the wine market that goes along with it. Yes, they are somewhat shielded because they're in that luxury space and people are going to be spending regardless. However, there's the possibility of trading down. So instead of people buying the $150 bottle, they'll now buy the $100 bottle, right? So that's definitely a possibility. We also have to take into account that luxury wine comprises roughly about 10 to 15% of the total US wine market. Um, and they're very concentrated, or shall I say, the wine market is very concentrated in the U.S., with 50% of U.S. origin wine sales really coming from, four, five, six names. They consider their drivers of success to be their 10 luxury brands, covering multiple different AVAs within the space. However, the two main kind of highlights of their portfolio are Duckhorn and Decoy. And we'll get into kind of the portfolio breakdown in itself. So Duckhorn has a price range of anywhere between 30 to 135. Decoy a little bit lower in the 20 to 35 range. And then when you're coming down to the omni-channel, right, they have very much long-standing relationships through their wholesale channel that represents roughly about 47,000 accounts, and 2.8 thousand direct to retail in California. And again, they IPO'd in 2021, right? And they gave a pretty general statement regarding what they're going to use the IPO, um, the money that they brought in from the IPO for working cap, paying down their revolver, general expansion, and further M&A, especially as a highlight of the fact that they see continued M&A within the wine space moving forward. Coming down to their marketing strategy, they have kind of three main segments. The first one is your consumer marketing, second, account marketing, and the third is new product development. Um, and then when I was looking at this, right, we'll get into the revenue build here momentarily, but we have to keep an eye out for, the business to business versus direct to consumer revenue growth and margins, right? What's the difference between those two and what's really going to be accelerating growth in the future? We really want to understand the portfolio breakdown by sales, right? And some of these KPIs and metrics they give us, but some we're going to have to back ourselves into. We want to understand the unit economics, right? So the price times volume, right? So how many of these cases are they selling? And what's the price they're selling at, right? Do they have the ability to take price? Do they have the ability to raise prices over time? And, what is really driving growth in that sense? We want to understand kind of consumer experience, right? Are those really driving growth, especially coming out of the pandemic where we had to see a lot of these wineries kind of shift away from a lot of the revenue deriving from in-person experiences and more trying to connect with people in a more virtual sense. I want to say that COVID is not going to be a large part of this build out, right? We're going to have to take into account some of the kind of normalizations that go along with it, and reaching normalization after that point, as well as trying to figure out what are we really tethering growth to, and what is the difference between growth opposed to, shall I say, an overall recovery, right? And with a company like this, we have to also take into account seasonality, where revenue is the highest. I know they highlighted that multiple times in their S1 as well as their 10Ks. Um, so yes, and looking back, I know this JPM kind of report was a while ago. JPM was the one main book runner who took this thing public. With that being said, the most recent report that I was able to get my hands on was JPM's downgrade from buy to hold on 9/15 of last year, or I guess 2 years ago it'd be 9/15/2022, where they were stating that Napa, in terms of long-term growth and operational performance, is steady. However, there are reasons to downgrade from a buy to a hold, right? And because they want to continue to expand, they're going to be increasing investments, and that'll really weigh on your profitability as well as certain metrics that we're going to be utilizing, and trying to understand the growth profile and difference between organic versus inorganic growth. Um, as well as, while they are outgrowing the segment within luxury wine, do they have the ability to continue to eat up more of the wallet? And they stated that, Napa's core customer is not as susceptible to inflationary pressures. However, they did believe negative wealth effects could dampen demand for the overall segment, as well as adverse weather patterns moving forward, especially within California. In terms of guidance, and this was again a while ago, they saw top line growth of mid-single digits with street consensus of 8.5 at the time, and they expected EBITDA to guide lower, especially as they continued to ramp their SG&A investments and try to build out a more robust direct-to-consumer channel, as that tends to be higher margins. Um, Now, coming to the most recent earnings calls, and usually what I would do is I would go through every single earnings calls from the last year to get a better idea of what the key arguments are, what the analysts are asking, and what are the main facets that are driving and altering kind of general price action, right? So in terms of management guidance, they do seem to be pretty straightforward in terms of what they're reporting as well as their overall guidance. So they said they are seeing some signs of softening in consumer sentiment, and this kind of matches up with kind of JPM, as well. And seeing the luxury wine trends kind of coming in lower than expected and the lower end of previous guidance, right? So they're narrowing sales guidance or top line anywhere between the 420 million to 424 million range with an annual growth rate of 46%. And they expect to maintain an adjusted EBITDA translating or EBITDA margin translating into the range of anywhere between 150 to 153 million. They noted that in the last 12 weeks, in the luxury wine segment, it was flat in terms of demand. However, the total wine demand declined 1.6%. I don't remember the exact source from this, but there's one main industry standard that is usually utilized to track this sort of data. Starts with C. I don't remember off the top of my head. I'll get back to you on that. As well as they provided more information on their most recent acquisition of Sonoma Couture, which they acquired for 400 million. They believe that this had a similar margin profile to the portfolio and has the ability to expand their varietals and overall offerings, right? And you have to think about this as potentially seen as as you grow, you have kind of this network effect. And coming down to some of the analysts' Q&A, right? They stated that while you're seeing overall double-digit growth implied for the second half, especially with the seasonality factor, it seems to be abnormal, right? And why is this going to occur, right? And this is very much going to play into our revenue build moving forward. So they said that this abnormal growth that they're projecting to kind of hit this year-end number of anywhere between 420 to 427 million growth by end of year, or 420 to 427 million dollar revenue kind of guidance was going to happen because you're seeing significant restocking or production of high demand labels such as Decoy Limited, which launched in fiscal year 23, which will be back in stock in the second half of the year, along with the Sauvignon Blanc and Chardonnay, which tend to be extremely high performers. And they are also stating that, questions we saw was, along with the slowing down of global wine markets, are we seeing some sort of trade down within the space? And they stated, they don't see any sorts of trading down, and they continue to outperform the general wine industry. So rather general in that sense, not really too much color. And some of the analysts continue to pry at the second half kind of expectations, stating that your margin profile remains somewhat similar. The company stated, however, you're going to see more shipping of high demand bottles, kind of coming back to this point here, right? So yes, that's kind of my research notes. Again, usually this would be 200, 300 kind of rows total, and I go significantly more in depth with this, but this is really more about the learning how to model opposed to trying to understand every single little facet. With that being said, we do want to understand the unit economics of this company, right? We do want to understand, what is actually driving growth, what is the margin profile in the future, and how are we going to take a look at this company moving forward, and what are the main drivers. So before we really get into it, let's take a look at kind of how I went about this, right? So your typical income statement, nothing too special in this sense, right? You're seeing fiscal year 29 and 2020. I don't have quarters for that just because of the recent IPO. Usually I would try to forecast or try to enter historicals quarterly for 5 years, especially with a company that has this sort of seasonality. and trying to get over that COVID hump, right? So in many ways, I want to use this 29 as or 2019 as some sort of an anchor. We also want to take note that their fiscal years are different than typical. Currently our fiscal year is we're in 2024, right? Upcoming is going to be in 21 days we'll be coming up on Q2 2024. So fiscal year 2023 ended um, in July, right? So yes, take note of that. And while we can take a look at all these numbers, right, and get a better idea of the company, um, I really wanted to break out EBITDA and adjusted EBITDA, right, and see how much fluff they're really taking into account. And I can look at line items such as, COVID-19 costs and wildfire costs, right? Those are going to be very much one-off events as well as your IPO costs, right? But you're taking into account, casualty gain, all of these different line items, right? And trying to figure out, are these going to be significant factors moving forward? And is adjusted EBITDA actually a fair way to look at this company? Moving forward, your free cash flow, pretty simple in a sense, right? All I'm doing is taking my operating free cash flow and then adding my change in working cash or working capital, giving my free cash flow. And then I like to break down my margin profile of my income statement. So, net sales, right? What am I seeing year over year in terms of growth, right? And especially when I'm dealing with times where you're seeing certain growth patterns that may be abnormal coming out of COVID, right? I want to look at a 2-year stack to understand, what happened in relation to years past. So I'll take quarter over quarter from 22 to 24 to get a better understanding of that. And then obviously your sequential quarter over quarter estimates as well, right? Oftentimes if I'm doing a full build out of this, I will do your if errors as well to see if there's any discrepancies in that. Now, with that being said, I like to take into account BIPs, quarter over quarter in sequential manner as well as year over year, right? And this gives me a better understanding, especially when I'm looking through equity research and on certain calls, I have the ability to really get a good understanding of what's being quoted, right? Because oftentimes an analyst, right, your JP analyst will come out and say, we're seeing an increase in cost of sales by 200 bips, right? Or we're seeing significant compression, et cetera, right? And that gives us a really good idea and another way to kind of look at things from an analyst perspective opposed to just looking, sales quarter or sorry, as a percentage. In my opinion, I like it a lot. And then gross profit, I like to look at, incremental margins, right? And what that means for the company. Um, I think it's definitely a great tool to have and something that we haven't done in the past, but I definitely want to incorporate moving forward. Um, so trailing 12 months incremental margins, I'll give you guys the equation for that. It's rather lengthy. You can use a sum function as well here to make things look a little bit cleaner. With that being said, it's a great way to understand the directional movements of margins. So yes, then SG&A is going to be a large component of this company as well, just because, they stated that they're wanting to continue to expand their direct to consumer channel, right? And that's going to take significant SG&A expenses, right? So in terms of overall, right, we saw year over year, 594, 600 bips of kind of increased SG&A expenses. And then just down here, operating profit, right? Get a better idea of everything above the line. So that's that. And then a nifty little function I like to use here as well. So I don't have Macabus or any kind of plugins that allow me to do kind of macros or shortcuts. So I like to do, FN5, and then reference special, go to constants, get rid of these, right? Highlight these, and then what I'm going to do is change the font color of this to 255 blue, right? Just to denote that these are hard-coded numbers. So, yep, that's that. And I mean, we can get into, right, 255 blue is what we want to use for blue in terms of, for hard-coded. In terms of linkages internally for sheets, what we like to use is either 128 or 131 green. That's completely up to you. And then for outside equations, what I like to use is a 131 red, 131 blue denotation for that, right? So again, F5 takes you to highlight those and be able to get a better understanding of all your constants. Um, Balance sheet, I'll do the same thing here, right? FN5, special constants, get rid of all those, highlight, F color, boom. Lovely. Go to balance sheet or cash flow statement. Sorry. Just link these up top. General linkages. You guys know how it works. Boom. Lovely. Constants. Fantastic. Alrighty. Looks like we're ready to go. Alrighty. Let's look at some of the overall trends that we're seeing. And EBITDA, right? Because at the end of the day, that's what we're going to be utilizing, and unleveraged free cash flow to give us our DCF kind of share price, right? In terms of EBITDA, we're seeing this kind of constant, to some extent. Let me see. Alrighty. Also, another note, I like to have these X's on kind of these sides that give me the ability to maneuver throughout the sheet in a faster manner, right? So I can go throughout, this sheet significantly faster. I think it's just more efficient. It may not look the cleanest, however, it's extremely useful, especially when someone else is going through your model at the end of the day. If I want to get a better understanding of all of the formulas that go along into this, right, what I'm going to do is press Control, the kind of squiggly line, the approximation line to the left of the one, right, and that allows me to do quick checks on everything. Fantastic. Alrighty, let's get into this. So, I already inputted some of these kind of historicals in that they give us in terms of KPIs. So one thing you want to look at is the kind of breakdown between your wholesale distributors, your wholesale California direct to trade, as well as your direct to consumer, right? So we're seeing over the kind of pandemic, right, you saw a lot of your direct to consumer. So that's deriving from your wine clubs, right? Well, you may not have your what is the verbiage? Well, you may not have your in-person visitations. It's still going to play a large part into it. And then moving forward, right, we're seeing down to 7.4% in Q1 of 24, with fiscal year 23 being roughly about 15%, right? And a big thing for me is I like to be able to denote in comments, right? All of everything that I'm putting into from the historicals, as well as key assumptions moving forward, just because it gives me an idea of why I did something, and also the person who's viewing it a better idea of key assumptions, right? So little notes that they gave me throughout the 10K or 10Q, right? Another Another thing I want to look at is your sales contribution, right? What is the breakdown between growth deriving from your volume, right? So how many of these cases are sold, and this price to mix, right? And price slash mix contribution, right? So in 2019, we saw this kind of even split where your top line was driven 11% by more volume, and also 11% by your price slash customers trading up for more expensive bottles, right? And moving forward into Q1, right, it's not looking too hot at the moment, right? Where you're seeing your volume contribution drop 3.4%. Um, or your sales, your top line pulling back 3.4% from your volume contribution and 1.8 from your price slash mix, right? So not too pretty in that sense. We do have to take into account seasonality factors, right? And now let's get into your volume times price, right? So this is breaking down your unit economics and understanding. So we can derive some of this from above, right? However, they didn't give us quarters, right? And they really didn't give us anything besides this initial number on their S1 where they stated that um, they sold 1.4 million cases in fiscal year 2020, which was noted in that S1, right? So we can take that and break it down to get a idea of the price per case that they're selling it at, right? So we can do, if you really want, they're selling at an average of $16.1 per bottle, right? Or 193 per case. What I should do here is alter the formatting on this. Sorry, guys. Uh, Fantastic. Lovely. So yes, and as we move forward, we can extrapolate this data by finding certain information online as well. Where I found an article by Shanken News that stated that cases increased 10% to one. The cases increased 10% um, in fiscal 2022, right? So that means that I can back more into this number based off of this number that I was getting, right? And from there, I can get into the point where I found a news source stating that from the same person stating that 1.84 million cases were depleted in 2022, and this data was pulled from Databank, which is one of their main sources that we can't really get access to, but every once in a while there'll be reports of it. So, we can see the volume, that is being sold as well as the price per case over time, and get a better idea of do they have the ability to continue to alter mix and price, or is, what is driving growth moving forward? And how I would like to do this, is by understanding and kind of projecting based off of this. Now, moving forward, I wanted to get a better idea of the sales percentage by brand as well, right? So this is a given kind of metric that they provided in their filings, where you're seeing your Duckhorn and Decoy are making anywhere between 73 to 80% of your total revenue, or I guess 79.2. So you get to break down that, number of what, revenue is being derived from these, right? And we can get a better idea, going back to our research notes, and this is a large range, right? But we're seeing Decoy being $20 to $35 a bottle, and Duckhorn being 30 to 150, 135, right? So that gives us a better idea. So this is our mix accelerator, and then we also need to take into account seasonality factors, right? So how we're going to do this, just getting a better idea of how much percentage of revenue is deriving from each one of the quarters based off of the total year. And we can see that, Q1 is constantly the most revenue, right? And especially as we've gotten kind of Q1 2024 data, right? This may contradict what we're seeing in their kind of earnings call transcript, right? Where they're stating we're going to see significant acceleration in H2, right, because of those new bottles. And that's something to take into consideration moving forward, especially when they're trading quarters. With that being said, one way I want to look at this is some sort of kind of over the past 3 years, right? I don't want to just take, this last year number and be like, okay, 26.8, that's what I'm going to play it off of, right? I want to take into consideration significantly more than that, right? So what I'm going to end up doing here is taking this, the past 3 years of data, um, and I screwed that up. I'm sorry, guys. There we go. F4 to lock all of that. So I can, lovely, right? And then right, just boop. Alrighty, so that's a seasonality we've seen from time to time over the past 3 years. Fantastic, right? So now we can take that into account in terms of, what we're seeing for Q1, right? So if we're just playing off of those numbers, 27% of the revenue would be deriving from Q1, right? So taking a look at, past years in Q1, we saw 108, right? And there's 102 million, which is not very pretty in a sense, right? But then we take into account research notes, management guidance, right? 420 to 427, right? So I mean, if you just multiplied that times 4, right, you'd end up with 408, which is significantly under what we would expect in terms of seasonality, if that's just, even or flat throughout. I guess it'd be 410. Sorry, but yes, so that's one way to look at it, right? I like to look at all of the different factors to get a better idea of what I can break down revenue by. Now, with that being said, right, I want to be using multiple multiple different ways to go about getting my revenue, because really this is, the most important part when it comes to understanding kind of the company and overall guidance, at least for this company, right? So consider distributors, right? DTC tends to have higher margins, while your wholesale distributors tend to be lower. And you're seeing this overall shift, which could, be leading to kind of, this, right? So, yes. What I also want to bring you guys through is index matching. A lot of people, there's a lot of different ways to go about this, right? In creating scenario analysis. A lot of people like the choose function, which is, really great in a sense. Some people like your VLOOKUP, XLOOKUP, etc. I think index match is the best way to go about this, and I can kind of walk you guys through that. I know a lot of you guys already know how to do it, but there's no harm in taking a deeper dive into that. Before we get into the index match process, I want to go over a few tools that I use often to get a better sense of maybe the company itself or possible predictors of future performance. And what I will say is maybe these examples may not be the most accurate or the best. It's more about showing you guys how I utilize them. So I'll preface that. So the first one I like to use is finding out overall data correlation. So What I did was basically I inserted the revenue from income statement over quarters, as well as I pulled data from Google Trends searches. And yes, this won't be maybe the most deep dive per se data that we are fully collecting. Oftentimes, I'll like to use data that maybe I get through equity research or through doing widespread searches online, or certain articles or different channel checks that I may go through. And what this allows me to do is get a good idea of possible potential data streams that could be good predictors of future performance. And for something like this, right, I'm using Google Trends data. It's very simple, it's very basic, everyone has access to it. I'm not saying that we want to use Google Trends in the future as a really good baseline, because oftentimes it is, maybe skewed, or it may not be the most informative or real deep dive. But for this example, I think it'll provide, a good idea of what we're trying to do here. So, like I said earlier, I have my quarterly revenue here, and then I also have the data of just the search of Duckhorn that I found from Google Trends. So this is people searching up Duckhorn online. And what I may want to do here is analyze it. And for example, right, we'll just run a simple correlation between the two data sets, and we'll find that they really don't have too much correlation at all. It's actually near zero, right? So for you statistics guys, a correlation of 1, I mean, it's perfectly correlated, and a correlation of -1 means it's perfectly negative correlated, and 0 provides zero correlation. So that's that's one way to look at it. But with that being said, maybe there's possible lag times, or people who visit Duckhorn, or people who search Duckhorn, are maybe gonna come, visit the wineries and the tasting rooms later on to the direct-to-consumer channel, which is a very significant part of their revenue, right? So what I may want to do here is take a look at possible lag times that may occur. So what I'll do is take a look at that, and then do Duckhorn T minus 13 weeks Google search, right? And then I'll do right? There is something. It may not be the perfect indicator, as it only has roughly about 0.5, so it's moderately correlated between the two, but I think it does provide good insight into possible ways to take a different look or take a different approach to data sets. And oftentimes you can deep dive and continue to take that next step, and try to find other data that may be good indicators, because we don't have access to alternative data, Yipit, Cleveland, M Science, etc., while everybody else really does across the street. And if you can find something where there is correlation and it's a good predictor of future kind of quarters, that can be a big leg up. And something like this, I wouldn't base a thesis off of it whatsoever. However, it is a good little morsel that we may want to keep in the back pocket and realize and possibly track, right? So yeah, just another thought, just another something else you can put in your back pocket. And oftentimes with other with other companies, it may work significantly better as well. And as you dig, you can maybe find other resources that could provide very helpful. So the next one I want to look at is a growth stack. So growth stack is interesting in a sense that it's possible that growth could be allocated not to the company itself, but more the industry, and something like understanding the global wine market versus the U.S. wine market or the luxury wine market um, may provide useful, right? And are they able to take significant share of wallet over the next 5, 10 years? And it all depends on your investing style, what you're really looking for, but that's definitely something to take into consideration. So for something like this, the two key questions you want to answer are: one, what is the growth percentage of aggregate consumption? And two, what is the growth rate of share of wallet? So what's their ability to continue to eat up market share over a certain period of time? And this can be a bit hand wavy, but again, it's just something else to have in your back pocket. And when you're dealing with a smaller, possibly more emerging market, I think it's really good to get a good idea. And oftentimes you have to extrapolate data, right? So the whole idea here is, I pulled a source from uh, Acumen Research, right? And they stated that, in 2021, um, there was roughly about the global wine market was 489 um, was 489 million, right? And by 2030, they expect it to be 825.5 million, right? So the whole idea is I'm going to have to extrapolate this data um, and figure out possibly what this CAGR may be, etc., right? And like I said, this is more hand wavy just to get a better sense of the overall market you may be playing in, and it'll be a lot more significant if you're in a smaller market that's emerging and trying to really understand the overall growth pattern. So what we'll do is boom to the power of 1 divided by count 1, 2, 3, 4, 5 minus 1. I believe that's the formula. Yes. There we go. All right, so you have a CAGR of roughly about 6%. So you can use that and extrapolate this data. So simply this times 1 plus this, fix that, boom, right? Now you have, all right, what I do? Oh, it's on me. There you go, something more along those lines, right? So you have a better idea of where say, the global wine market is going. And like I said, in this example, it's maybe not as pertinent or you know, as useful, right? And now I have the other way, right, where they gave me a CAGR of 6.8% by 2030, right? So uh, right, so this will just be yep, boom. All right, so now I understand kind of where my market is moving, and now I can apply it to my company itself. So right? So that's if it grows with the anticipated CAGR, and oftentimes these can, this can be lofty, right? It's not one of those things where it's an accurate prediction. Oftentimes your consultants want to juice the overall numbers to make, clients happy or whatever along those lines, but it's a baseline, right? It gives you a good idea. So, um, from there, what we can do is, get a good idea of possibly this, this growth that we're seeing, and let's just say, we're just going to um, make up some numbers here. Oh, my bad. There we go. Alrighty. Um, all right, so we're seeing overall, what we've seen before, and then from there, what we may want to do is, assume that what have we seen historically in terms of price kind of contribution. We're seeing, losing a little bit of price and mix. That being said, it's up 11.4 in 2019. COVID, just trying to get shipments out the door. 2.6. Let's say that they're going to be looking at um, let's go 2.5. Why not? Just for excellent. And from here, we can, take a better look at the possibility of your volume growing as well. And again, a bit hand wavy here, but we'll play around with it. Um, uh, right, there's your kind of your looks at things of possibility that could be coming along in the future, right? And then you can come down here to estimated revenue, and then so we got bad, guys. I forgot to. There we go. A little bit of difference here based off of compounding, but regardless, you get the point. So that's a possible way to look at things as well. Again, not sure if it's the most pertinent in this case. However, it does give you a good idea of possible ways you can play around with this, right? Yeah. Yeah. So that's another tool to have, in your back pocket, and it gets, gives us a better idea of um, potential market sizing and the whole argument of TAM, but again, not super useful in this company or this example, but more of a way to show you how to navigate this and implement it into um, your other models. Some other things that I want to mention are, there's 4 or 5 of these other tools that I like to use frequently, and I can go over those at, on a later date with different companies. I just don't think they're pertinent to this. So yes. One thing that I forgot to mention on this kind of correlation, what we can also do is build out a graph to better visualize this data. So for example, what we can do is go here and then all charts combo line, put that on secondary axis, right? And it gives us a better idea of, gives us a better idea of correlation between the two. Sweet. Right, but bam. Right, now we have a better idea of the kind of correlative factors. So you can see as of recent, there's been less correlation between the two, and that can be, in my opinion, probably um, taken into consideration based off of the fact that you're seeing less DTC, right, in their overall mix. right? Because that's a a big driver and I think an indicator, less about the wholesalers who are looking this up, and it's going to be more along the lines of the actual end consumers and wine club and wanting to visit Napa in general. So that's a cool little trick that we can utilize as well. Uh, so, oh, no, sweet. Alrighty. Let's get into the index matching of things. So what we're going to want to index match are two kind of main levers of this. And it's going to be simple. We're going to keep it simple just because um, the goal here is to provide insight into how to model opposed to how to get everything, or depict a completely accurate story of this company or narrate a probable future of this company. So what we're going to do is first we're going to create some sort of scenario analysis. So boom, what I'll do here is just I don't think I used that. That was like it. There we go. Sweet. So scenario analysis. The first thing going to want to do is do our volume. That's going to be in cases. And we'll just copy this actually. Do not like how that has. Boom. And for this, we're going to want to do bare base bowl, as well as we want to do a year over year, a change in percentage year over year. I'll just copy something off my income statement. Sure. Just because I don't have that. Perfect. Alrighty, sweet. And now from here, what I'm gonna do for cases, I'm just going to have the base case be my historicals for my volume, right? So, alrighty. Formatting here, and oftentimes I'll do formatting at the end opposed to this, but this is just kind of bugging me at the moment. Excellent. Okay, I think there is one line over here, yeah. Alrighty. Okay, so I have my bear case is what I've done here historically. I guess what I can do Let's just do it like this. That shouldn't be green. Excellent. And now this will be my percentages. Where did I put it? There it is. Sweet. Alrighty, so these are my percentages of growth year over year in terms of volume of case, right? Now from here, I'm just gonna copy this formatting down here, copy this here, and then this will be price per case. The same thing down here. Sweet. Alrighty, so look at my price per case here. And then fantastic. Right, so now I have a good idea of what I'm seeing on a year-over-year basis in terms of increase in price and an increase in volume. It's going to be extremely helpful when projecting out, especially on the year side. For the quarters, we may have to improvise a little bit. That's where seasonality factors come into play, right? We have to remember what guidance said on Q1 earnings call. However, we should take a look at overall seasonality, but we'll do that after an index match. So a whole idea here with an index match is what I'm going to need to create is an overall button. So how I'm going to do that is insert a column over here, do 10, right? And then from here, what I'm going to do is Alt A, my bad, Alt A V V, and then I'm going to do a list. I'm going to source that list from here. So my bare baseball. So this is going to change and create a button. So just for lesson purpose, data validation, and then you go down to list, and then you're going to do bare baseball here, right? And this is going to be, I'll be able to do a drop down and bare baseball, right? So, maybe want to make this a certain color. Boom. Scoot it up a little bit. I want to do it here. Um, Sorry about that. Volume. There we go. And now we're going to have a little button here that we can refer to. Boom, boom. Right, and then we're going to have another one here for price. And it's going to be the same thing. List, and then to here, boom, drop down here. Same idea. Alrighty. There's our buttons. So moving forward, now we're going to need to create the actual inputs over here. So we're just going to do something completely random just for just to kind of demonstrate how it works, and then we'll get to inputting something a little bit more consensus and a little bit more correct. Why did I end up putting that? Where's my percentage? Okay. Already, so just put 3, whatever. Excellent. Now it comes to the index matching. What we're going to have to do is we're going to have a reference. So on this scenario analysis, what I'm going to do is have it equal this. And you'll see in a second here what I mean. Excellent. And then actually for ease at the moment, we'll do that. Okay, so let's work on this index matching. What we're going to do is index, right? So then I'm going to be able to choose my overall array. So for this one, right, I'm doing volume. So my array is going to be this. I'm going to want to lock that all in place. And then from there, I want to do my matching, right? So what I want to do is I want to match this, right? And I'm going to also put that in place locked. Yep. And I'm going to match that with the array below, right? So this is referencing this, matching the two. And then for this, I'm going to do an exact match. Close the parentheses. Let's do another match, right? And now this is going to be me matching this. And that's not going to be locked in place. However, we do want it to slide horizontally as we copy the formula over. So what we're going to do is do something like that. and then have it matched with this here. Close that. Oh, no, 0. Close it, close it. And now we should have some sort of match, right? So this is the volume. This is the percentage, right? So oh, that's forgot to lock these. As well as these. Sorry about that. Bam. So when I look at this, I see my green, it's moving along with this, right? So as we go, it's referencing that individual column, and we still have our button still locked. So the whole idea is now when I go to over here, I have the ability to alter it, and it's going to be referencing these, right? Excellent. Now we don't want the percentage, right? We actually want it to be based off of the kind of last that we saw here. So just we'll keep that in mind. And let's say just wanted to do it as if there's no seasonality, right? What we're going to need to do is just multiply last year's. This is not the correct way to do it in terms of actual projecting, but this is just for functional purposes. Multiply times that divided by 4, right? And now we have, I'll just do this here, and now we have how many cases we get in a single quarter. Do one more thing here. Do all of that plus 1. There we go. Boom. Sweet. So just a quick recap, right? First we want to create a button, right? And this button is going to be linked to down here, right? Based off of these parameters. And then from there, right, I'm going to do that by going to data, go to data validation, and then go to list, and then select my volume, or sorry, select these kind of 3 here. And then from there, what I want to do is build up my index match. So just a quick recap. What we are doing is we are, first of all, taking the index, the array, right? We're taking the array, which is down below all of our values from 2024 Q2 to 2028 or 2030. I don't remember off the top of my head. And then from there, we're going to match our button to the bare baseball cases down below. And then after that, we're going to match the dates, so it creates some sort of sliding effect. And bam, there you go. There's your bare baseball. Now, when we take a look at this, right, this is not entirely accurate. This is just for um, more of an idea of what we want to kind of work with here. Um, let's do this with also price per case as well, right? These numbers we're going to edit later to make it a little bit more accurate and match guidance, especially with seasonality. So what we're going to do is here, I'm going to take this, and in the future, I want to teach you guys how to project with incremental margins, but that's going to be at a later date. I just want to kind of get through this and get you guys up to speed. So here, we'll just do, I understand this is quarterly too. We'll do a little 2.5 just for kicks. Right, let's say price doesn't increase at all. They're stagnant. Let's say they have more pricing power. Right, and then boom. Sweet. Let's see what we got going on here. Delete that part. All right, so this is still on here. Move these down. And boom. Sweet. We're gonna have to come back to this and edit a little bit, but you get the points, right? Because we fixed ourselves in a certain manner, it allows us to because we fixed ourselves in a certain manner, it allows us to easily copy and paste. And when we're doing bare-based bowls with a whole lot more of these different factors, that's when that comes into that's when that comes into play. We're gonna hide those, and bam, you have your bare-based bowl scenarios. Now it's just all about getting the right information that we want to put into it, and we can toggle with this and play with it, right, and see what we end up getting. But yes, that's bare baseball in a nutshell.
Okay, so we did a little bit of shifting around here where we moved the index match up to volume contribution as well as price slash mix contribution. And after going through some of the filings, I was able to find the Q4 numbers as well for year over year change in regards to price and mix as well as volumes. That'll help us out moving forward as we project. Now, from there, we want to get a better idea of how this flows into our volume and price in terms of actual units. And what we did here was we were able to figure out our initial volume slash price because we needed a base to play off of. We were able to use the number that we found from the S1 of 1.4 million cases and take this number and multiply it times the volume contribution change on a year-over-year basis, and then from there we were able to figure out this number through overall seasonality. Yes, it's more of an estimate, but when going into the quarter-to-quarter change compared to our revenue that was actually reported, this difference is rather minimal, right? Moving forward, we see small discrepancies between the two. However, for an estimate, I don't find it too worrisome, and I find it pretty accurate, especially as we have to use some sort of base to go off of. So yes, it's some sort of a rough estimate. However, it will do the trick in this scenario. So moving forward, what we're going to need to do is, for volume of cases, we're going to have to reference the past quarter and multiply it by the current one here. And then we're going to do the same thing for the price. Fantastic. Excellent. So now we have this, and now it will spit out our revenue number. Right, so this is more on the lower end if we're going to keep it currently. Remember, guidance was anywhere between 420 and 427 million in top line. And off of that, I believe from overall consensus and taking a look at past seasonality, usually Q1 would be the highest in overall revenue as a percentage of quarter if we go back here. However, we're seeing significant pickup with new varietals in the back half of the year, and they're expecting acceleration in the back half of the year. And that's due to, one, overall volume, right? So we'll come down to here, and we'll change this to, to 5. And I think that's, getting us in the right direction here. In terms of Q2, on a year-over-year basis, we may want to keep it somewhat flat. Right, and here all we did was just multiply this by this to give us our volume number, and then we had to translate the units back into by dividing by 1,000. So this is on the lower end at the moment. Still, I think historically, last year we saw a increase in price of 2.6% overall, and we will go the opposite direction and calculate this for fiscal year 2024. Because we are summing all of the quarters here. But the whole idea is we're going to want to play around with these numbers. Usually you're going to have a pretty intact thesis regarding this. However, in this case, I think it's going to be more about just finding consensus and where is consensus. So the increase in mix of their higher portfolio names or higher mix portfolio names, I think will lead to an increase in price in Q3 and Q4, right? So we'll do maybe like 3.5 or 3.5 here, and then 3 here, giving us roughly about 416. And then overall volume, we'll go 5 here, or sorry, 5 here, 4.5 here. Now we're at the lower end of consensus. Now we can find some sort of increase here. And remember, we're playing off of a quarter-on-quarter, a period-on-period basis, so the base would change, right? So in terms of price, we saw an increase in price in quarter-over-quarter of 5.2%. We're not sure if we're going to see that again. They stated that in management because we saw a new integration. But I do think you're going to see significant volume pickup and this continued growth in volume due to these better selling wines that they're recently introducing. So we'll account for that. Or we'll give them, 7% here, right? And that may feel a little bit hefty, but that is within their consensus to accelerate in the second half because they're restocking and selling more volume. So I'm not too mad with that number. And then from there, we're just going to bring out these here. Do the same down here. I guess that should be identical, so just copy this. And these are year over year. And then these quarters will become irrelevant. And we are on our way. And then for these numbers down here, what we're going to have to do is a weighted average, so some product, and then I'm going to take this along with that, and then divide it by the sum. all of this, and that should give us our weighted average cost for the year, or price per case for the year. And then our volume is just a sum of all of those. Now from here we can go so 2.6 volume increase and price mix. .7%. Great. Oh. Okay. So now what we can do is keep on moving with this. There's our revenue. Now we may want to tweak this in regards to our cases down below. I don't have ultimate conviction. On, the rationale behind this. We can say 4%, right? Let's say they're going to have a better than average year based off of their acceleration of new vintages that they're putting out there. Or you can have some variance in there. And usually I'd have a thesis to accompany every single number that I put in. However, I think that's rather fair. And we see some significant seasonality here, right? If we take if we take into account what we're seeing here, yes, it's a little bit off of, historically, Q4 is about 22%, so we may want to tone that down a little bit. We may want to see, we're going to see 2.5 here, we're going to see 3.5 here, and 6, and then 6 here, just so we see acceleration in the second half. Right, and that'll give us in the lower ends of the bounds here, and ba-bam. Now we have the majority of our revenue build really pretty much done here. I wish I had consensus numbers on the out years. I don't off the top of, like, I don't have Bloomberg access at the moment, so that's kind of a shame in that sense. But now what we can do is we have our unit economics really down, so we can see, you know, in terms of cases on a year-over-year basis, we're, you know, growing anywhere between 2.7 to, or I guess 2 to 5% in terms of volume. And we can also change this here, right, with our different case scenarios. Say we're, you know, so they're losing significant market share. They're losing significant market share. We're only gonna, you know, they're gonna miss guidance this year by 10 million, and Q3 is going to be extremely weak. Q2 is going to be slightly more volume than Q1, and we're going to see significant acceleration into Q4. We'll set it back to base now. We'll go over to our income statement, link the two. And ta-da, perfect. Now we have a revenue build done. We'll be moving on to our expenses build, and then working our way through working capital and also a debt schedule. So now that we have finished our revenue build, we want to get into our expenses build, and then we'll work our way through working capital as well as a debt schedule. In the meantime, I'm going to want to link this up here. Ta-da! There we go. And then ta-da! There we go. Alrighty. So next step, let's go through cost of sales or cost of goods sold. Let's get into our other expenses, income tax expense, which will be denoted in the 10K and SEC filings regarding the tax rate or effective tax rate. And let's get going. Okay, so whole idea here is I'm going to take cost of goods sold from here, and then divide this by the net sales, and don't have X over here. Bring that down just to make it a little bit easier for me when I'm copying and write. There we go, percentage of sales. I'm just going to pull this directly from some of the other formulas that I had down here before. So for here, I'll take all this information, left it, sweet. And then get that black. So now what we're going to do is we want to have this also sensitized. So we see that in Q1 it's roughly made about 47.5% of sales, and this is a variable cost, right? It grows directly with my revenue, because if I'm going to be producing more wine, then I'm going to be needing more grapes. You get the gist of things here. So what I'll be wanting to do is create a expenses scenario analysis, where well, bam. So first one's going to be my cost of goods sold, and then I can literally just copy it. From there, and now my base is going to be this. I guess I should do it the other way around here, so I'm not going in circles. Perfect. And then this is going to be like this, and then what I'm going to do is I'm going to reference this from here. Excellent. Perfect. Okay. So now what we're going to want to do is we'll put just a random array in for now. I guess we should make all of these. All these percentages. Same formatting here. Fantastic. So right now we'll just for ease, we're going to do 47%. And a var case, we'll do this plus 0.03, get that, and then we'll do it symmetrically. Ta-da! And now what we're going to do is we'll want to make, again, an index match, so insert a column here. And then we're going to want to build a button again, right? So lists, make that source these here, ba-boom. Now we have a button. I'm just going to copy the formatting from my revenue build on the button itself. Probably would have taken me the same amount of time, honestly, but that's okay. Now we have our button. And we'll do something similar for all of these. But until then, let's put out that index match real quick. Before we do that, remember we have to make this reference point. And we'll just do that for ease of use at the moment. And build out our index match. Our array, again, is going to be this. Fix it. Match. Our initial lookup value is going to be here. We're going to fix it there. And then the lookup array is going to be here, which we're going to also fix like that. And then 0, comma, and then we're going to match again this with these. That's going to be fixed fully. Boom, boom. Right, now I didn't double check to make sure I didn't screw anything up. Fantastic. Now from here, I'm going to do just times our income statement. Like that. Boom, boom. Right, that's our cost of goods sold. And take this here. Just paste it down there. We'll get rid of the highlight there. My bad, I should have done both of these here. Move that there. Control right. And ta-da. Perfect. Now we're going to do something similar with SG&A. Come here. Take that formatting there. And same idea. Formatting. Take these. And then from there, what we're going to do is, again, take this, get to my SG&A. Boom. Excellent. And then percentage of sales, we're going to do under base, do this divided by income statement. Fantastic. Do a similar thing here. Except now we're going to change this to just 27. Just for ease at the moment, to make sure we don't screw anything up. Now we're going to create a button. Source here. Lovely. Same formatting. Base, boom. Percentage of sales, and we're just going to take this year and literally just paste it. Fantastic. Okay, and now that we have pretty much copy this formula, now this index match is pretty much the same. We're just going to copy it down like that. Forgot to make these move along, that's okay. And that seems like it should do it. Just make it easier for ourselves in the future here. Well, what did I do? Nope, that's not it. Alright, we'll just I'll make sure I didn't screw this one up. Nope, that's good. Cool. To the right. Make sure the toggle works. Excellent, we're in business. Now we want other expenses. So other expenses is a pretty minuscule line item, and what we want to do is take a look at our SAC filings and what it really encompasses. From what I remember, it was primarily your credit facility, origination expenses, and all those costs that go along with taking out debt. With that being said, I don't think it's going to be a massive part of our overall thesis, so I'll just keep it pretty much in line with historical, what we've seen. So from here, I'll just do same type of thing, right? Other expenses, control write it. And then I'll do same deal here. Equal other expenses, boom, sweet. And then just like that. And then this will be as a percentage of revenue. Copy this. It really is a minuscule line item. Alrighty, now we're going to create another one of these, and I'll show you guys how to link all of these together, so we can play around with it and create different scenarios off of what we want to do. List, source, other expenses, now we have our toggle. And then what we're going to do is just take all of this, and again, same idea here. Now, index match formula, copy this down. Ta-da. Boom. Everything's working in tandem. And what's going on here? This is U5. There we go. Copy this down. U5. Ta-da. And I apologize for being a little bit slow with the shortcuts. I'm on a different keyboard at the moment, so can't, still getting acclimated. So now let's go to income tax expense. This will be pretty straightforward. This isn't really going to have any scenario along with it. So when looking back at historical income tax expense, I'll pull up the 10K for us here. We can see that year over year, may have skipped it already. Here we go, right? So we see that 2023 was federal 21%, state was 5.3. So this total was roughly about 26.7, 27, 27. What we can do is just take an average of those. And just do as a percentage of pre-tax income. From there, I should make that green. And I'll go through formatting here at the end and make sure everything's in a good place. We'll just do an average of the past 3 years, because there hasn't been anything that is really dramatically altered. And then it's going to be a bigger number right now just because we haven't inserted the other lines in yet. So I can denote this here where there's 21%. State tax rate is anywhere between 3.9% to 6.4%. So like an average of past 3 fiscal years. Excellent. So now that we've done that, let's come over to our income statement and input these numbers in. So our cost of sales, come to our expenses build, cost of sales. Boom. I don't have my make those green. SG&A. There we go. Impairment. I don't have the ability to actually predict these. We haven't seen it really historically either, so I'm just going to put them at 0. They aren't too tangible to the thesis. Unless we're going, in adjusted EBITDA, it may play a little bit of a difference, but we haven't seen anything in 2024. Therefore, I feel like it's reasonable to say that we aren't going to see it in the future. Interest expense, that's something we're going to have to deal with here later. So what I'll do is I'll just pull a little red box there to note that I have to do it here soon. Other expense. There we go. And there's our pre-tax income. There we go, something's a little wrong there. Let me just double check all my formulas. Excellent. Income tax expense. And we can play around with this later and look at the 10K and get a better understanding of what this encompasses and what NCI is attributable to, and if that's going to be moving forward. So that is our expenses build. Next we'll be doing our working capital. Now that we've finished our expenses, let's get into our working capital and D&A. So a little update here. I did some of the formatting just to expedite this, and we'll go over all of these individual line items. But I wanted to point out for D&A how different companies separate their depreciation and amortization, and how it's not always tethered to just your PP&E. So for this company, for Napa, we see that, and this is the 10K from 23. We see that, yes, we have property and equipment D&A deriving from or within your SG&A, right? It's baked into your SG&A or recognized in your SG&A. However, we also see it in our inventories as the company capitalizes inventory depreciation for the lease costs and production of that inventory and depreciation of the inventory itself. So that's definitely something special to this company, but you can find it always in the SEC filings and under the notes for each individual line item as it's necessary for them to disclose that information. So what I did here was separated my inventory depreciation as well as my PP&E depreciation, and they also gave me the amortization broken down as well. But before we get into that, let's get into our working capital. So first is our accounts receivable, and we have three main ratios that we like to use to forecast our accounts receivable, accounts payable, as well as our inventory. So what we like to do is take our inventory and use a ratio referred to as days inventory held, DIH, and to do this we take to calculate this in historicals, we take our inventory, divide it by COGS, and multiply it by the period. In years it'd be 365, in quarters it would be the quarter length, or an average, which is 91.5. And for days sales outstanding or accounts receivable, we'd use days sales outstanding, where we take our accounts receivable, we divide it by the revenue and multiply it by the period. Days payable outstanding is for accounts payable, where we take our accounts payable, divide it by the cost of goods sold, and multiply it by 365. And then for forecasting, you just rework those equations, and your input is going to be your assumption, your ratio assumption based off of what we've seen in the past. So first what we want to do is we're going to take the beginning of period is just the last period's end, and for here my accounts receivable end of period, I'm going to go to my balance sheet for accounts receivable right here, fiscal year 2019, to the right, and then I'm just going to take the difference between these two to get my change, which will be found on my cash flow statement. So moving forward, I can forward this right. We're going to see that this is going to be not available because they didn't provide this information on the balance sheet because it IPO'd in Q3. So we didn't get information, or we didn't get the information for that. And moving forward, we're going to continue to do this. However, for the end of period for the fiscal year, it'll be the prior year. Or sorry, at the beginning of period, it'll be the prior end of period year. And for these ratios, what we want to do is calculate our days sales outstanding. So what we're going to do is we're going to take our accounts receivable, and then we're going to divide it that and multiply it by 365 because it's a year, giving us 35.7 days. We can do that there as well. And then we want to go here. It will give us a value just because there's no information there to play around with. But we will just move forward and put this here. It's going to give us a different number because we haven't divided that by 4. Boom. We're going to take this, put that there. Then our end of period is going to be that, and we're going to see change there. We'll get rid of that. So whole idea here is this is our years. And this is our quarters. So now that we have the full there. And just double check our equations here. KLT, wonderful. Now moving forward, what we want to do is have a day's sales outstanding that we're going to be playing off of. So the whole idea of a day's sales, what it's measuring is when I recognize revenue on my income statement, it's not always going to be converted to cash immediately, therefore it'll be held in accounts receivable, and how long it takes me for it to convert that accounts receivable into physical cash for the company. So what we're going to do is, looking at this, we can see that it's usually within the 40s range. We see some inflection points in Q1, it seems like, and then it tends to come down back to the 40s. So in this case, we'll give it 40 for the quarters here. And then from there, we need to calculate it, so we need to do the exact opposite. So we take our assumption, and then we're going to divide it by 365 divided by 4, and then multiply it by our revenue for that period. And that gives us that number. And boom. Excellent. So now I can just go through the quarters here. We're going to do, that's going to equal that. This is going to equal the past fiscal year, and that's just going to be the change. And then we can just backdoor it here. Giving us this number. So again, this is going to be your assumption that you're going to be forecasting off of. And this is the equation you'll be utilizing to back your way into it. So we'll keep it with 40. I feel like that's quite fair. Excellent. And there we have it, folks. accounts receivable done. And we're going to do something very similar with your other ratios as well. We can walk through that. I'll make it a little bit quicker now that you guys understand how we go about it. Now, same idea here. We're going to use our accounts payable divided by our COGS. And then multiply it by 365. It's quite a large inflection there. We'll go back and check it just to make sure. However, I do feel like that is correct. Now that we have that done, looking at it on a quarterly basis, Q1 is 93, then it dips down significantly. It seems like Q1 is your inflection point. 1898, and then in terms of fiscal years, it's around 7.7 to 94. So from there, what we'll do is we'll do 18, 10, 8, and we'll do this. Excellent, now we just have to go the other direction, so we're going to multiply this, divide it by 365 divided by 4, and then multiply it by our COGS. And there we have it. We'll reverse or back our way into this like that. Equal that, giving us 8.4, which is pretty on par with the rest. Don't mind that whatsoever. Now with that being said, copy this, paste that there. 5. Now we'll just do 10 days. 6, 10, 7, 6, 10. We'll do 9. And excellent. There's our accounts payable done. Inventories, we're going to use our days inventory held. End of period 2019 of inventory. There we go. To the right. And then days inventory held, what it's going to be is I'm going to take my inventory number divided by my COGS. 2019 COGS, and then times 365. So we can see this is a very large number, right? Put that there. Divide that by 4. Boom, boom, boom. Then from here, what we're going to do, again, we're calculating our end of period, our days inventory held. For quarters, 500, 600, 700, 5, 5, 7, or 673. This was higher than in past years. I think we'll see some acceleration in the back end actually. There's 600 here, and then 575 here. Then from there we need to calculate this, right? So we just take our assumption, divide it by computer's being a little slow right now, I'm not sure why. Right, make sure that's referencing that, and then take this number here, oh, excellent, do 600 there to make it on par with last year. From here, take that number. And there we have it. Don't like this formatting. Excellent. So there are our main efficiency ratios done. Now let's get into some of these other line items, such as our prepaid expenses. So there are many different ways to go about these different line items. There's some typical ways. However, I like to denote what this kind of is. So prepaid expenses is primarily made up of foreign currency forward swaps. Therefore, I'm going to put it in SG&A or tether it to SG&A. So as a percentage of SG&A, other assets, what's this? Primarily interest rate swaps. I think it's going to grow along. I guess that should grow along with debt. However, just to make things simple, I am I guess that would work there. Percentage of revenue. Accrued expenses. So primarily trade spend, so amounts owed to distributors for performance incentives and invoices. Therefore, I'm going to tether it to SG&A. Accrued compensation, SG&A. Deferred revenue we'll deal with later. We'll go through the 10K and get a better understanding of what that means for this company. Typically when you're dealing with deferred revenue, it'll be off of the past 12 months. And in this case, it's a little bit different because of their vendor contracts. Other current and non-current liabilities, we're just going to grow with revenue. So we'll get into that momentarily. So let's get into the other line items, such as prepaid expenses. I'm going to pull this from the balance sheet. Other assets. Accrued expenses. Accrued compensation. Other current and non-current liabilities. break these out in two. I believe on the cash flow statement it's in one, so that may be a problem, but we can play around with it. A little confused why non-current liabilities under. Not a big deal. Regardless, we'll figure it out as we go. So you want to make this as a percentage of SG&A. Go to the income statement. We're going to fix this just so it makes it a lot easier when we're moving forward. Percentage of revenue. Percentage of SG&A. Just take this up here. Take this there. And then this one's going to be as a percentage of revenue. So perfect. Excellent. Now we can get a better idea what I might want to do is just get rid of these, but that'll come down the line. So for prepaid expenses we see expenses, which are foreign currency swaps. Go that along. We'll do 30%. For the quarter, it's going to translate differently in the year because we are doing it off the balance sheet. That. $7.7. Go a little bit higher. That works. But on a yearly basis, we're going to make it 9%. Other assets going to be as a percentage of revenue. You see it constantly hovering As of recent, it has grown to about 2%. Take a step down here. And this is interest rate swaps, so moving forward, this should go down. To 1.5, 2.3, 1. We'll keep it at 1.2. Excellent. Accrued expenses, percentage of SG&A. Now, performance related. What do we see in terms of seasonality here? Q1 is going to be in the 200s. Q2 is, or do 110. We'll come down to, I guess it was higher there. 120. Then Q4, 105. That because it's on the balance sheet. Take any of these. Then we'll keep it at around 28. Alright, accrued compensation. I should make these blue as well. We could do it later, but we'll might as well do it now, just for efficiency's sake. Accrued compensation, it's going to be SG&A. Just turned on my scroll lock. Let me pause it quickly. And we're back. Turn it off. Okay. So we now have all of these projected out. Now let's get into our depreciation and amortization. We're going to be using a singular style here where we're taking beginning of period and end of period. However, we are also going to be taking into account CapEx, depreciation, and other investments. So beginning of period, that'll just be equivalent to end of the previous period. End of period, we're going to link it. To there. Control right at once. CapEx are going to go to the cash flow statement. Purchase of PP&E. Excellent. Depreciation. Going to come down here. Get our total depreciation. And this is going to be the difference between these two. So this, they made an acquisition, so that's going to be play into it. Ideally, what I should have done here was actually, I screwed this up a little bit. Should have taken all of this from down here. Then we're going to project this or take it as a percentage of revenue because they're going to continue to reinvest. Moving forward. C. Yep. Excellent. I should have done that one as well. Just don't know what I'm doing here. Make this negative here. And now we can come up to here and reference this. this, do that, do that. Q423, just double check all my stuff here, Q423. Now what I want to quickly do, I'll pause it. I want to check their acquisitions. Alright, there's small discrepancies here and there, found in other, however, pretty good. I switch this to positive because it's an inflow of PP&E, depreciation, outflow of PP&E, and other investments is everything else that goes into it. Next I want to take my D&A divided by my capex to figure out if I'm constantly there we go. '21 we pretty much replaced. '22 we saw significant investments in a winery. And in '24 we saw something similar. Now I can't model that out as if it's going to continuously happen. In guidance they said they do want to continue to expand. However, they didn't give an exact time horizon. So if I was modeling this out, I would have to build out a full merger model to go along with this to get an idea of how long it would take for these to get up to scale and fully integrated and synergies baked in, as well as getting a good idea of how it would affect margins in current company, along with debt schedules, etc. With that being said, on normal years it seems as if you can't take 23 as normal, minus the 50 mil acquisition, 54 million acquisition, it's pretty much flat. minus the 36 mil acquisition, it's not quite flat, but nearly. I'm going to go along the lines and say D&A is going to continuously, I guess it's just depreciation, sorry. I'm going to say that depreciation is going to be probably about 80, 75, 80%, and I could build out a full waterfall. If I wanted to, I can do that another time, but I don't think it's necessary in this case. So I won't be using this as the actual input. Instead, I'll be doing depreciation as a percentage of revenue as my input. As well as CapEx as a percentage of revenue, along with your intangibles as well, or purchase of intangibles. And from what I know and what I recently saw, I'll pull it up for you guys here. In terms of amortization, you have your customer relationships only as the definite lived intangible assets, and that has been going down consistently, roughly about 7.6 million every single year. Sorry, 7.7 to 7.6 million, and is projected to go down, a fair amount over the next period of time as well. And they don't really invest in indefinite lived intangible assets or intangible assets in general. It's primarily all going to be a part of trade names and lane rights. This used to be a larger number. Our definite used to be a larger number, but we saw them mark it down from, I believe, 151 million to 139 million for their trade names. So moving forward, I don't believe there's going to be any purchase of intangibles. It's all going to be directly correlated to, or all of your investment is going to be in your CapEx. And we'll do this. So depreciation as a percentage of revenue seems to be constantly hovering around 5% every year. This isn't really material to our model, nor will it really hold material effect to our projections. Darn it. There's your D&A number, which we can now link. Turn that negative, just like that. CapEx is a percentage of revenue. This is a tricky one. We are seeing continuous reinvestment. We'll do that. Keep it like that, why not? And there's our PP&E. Just do this. When it comes to intangible assets, we really haven't seen any purchases from them, nor is it predicted to for them to have any purchases of intangible assets. So it'll be, a similar type of deal here. There it is. We are seeing a significant difference here. I'm going to have to go back and check this. However, I do believe this was due to the significant write-down. We'll pull it up quickly. Yeah, we saw this massive write-down here in trade names from Definite, which was the heavy hitter, along with your customer relationships, which is Definite. So we'll note that there. Excellent. Realized I didn't put in amortization for the most recent period. A amortization of intangible assets of 1.9 million. Okay. Excellent. That's more like it. I do want to check Q4 2022 as well. Hmm. Regardless, it's not really that material. I just wanted to find it. So now that we have that, what we're going to do is we also have kind of the amortization schedule provided to us. amortization expense for the following 5 fiscal years. Alrighty. So in 2024, let's see, 9721. Oh. Sorry, 7560. That's really going to be 60 equals this 4. And then from there, we're seeing that till 2028. Then 2029, we're going to see a fall off and probably renewal of those customer relations, which will round off at, I believe it stated that your amortization is in between 10 to 14 years for your customer relations. So we know that that's going to have to be renewed here in 2030, so that'll affect the cash flows in that year. We'll account for that. This is just 0 the entire time. And then in this year, you're going to have to buy, we'll give it a round number, and that's going to be amortized by 12 years like the last one. Just do the double check the math here. $12.2, yep, 12 years. And I'll leave a note here. This is not the cleanest way to go about it. And probably not a really good practice to get in the hang of here, but I just want to get us through this. Usually you build out more of an amortization schedule. Excellent. Sorry, I'm getting tired here. Excellent. We'll do this because just for formality's sake. Sorry about that. Computer shut down briefly. Alrighty. I guess we still have to do this as well. So I'm just completing my accrued compensation based off of the previous year. Based off of the historical information. This is going to be pretty straightforward. Same formula, you get the deal. Ta-da! Fantastic. So now what we want to do, oh, I guess I didn't finish this already, so let's make our way through some of the rest of this. Oh, we still have to do other current and non-current liabilities. And this is listed as to grow alongside with revenue, so what I'm going to do here is just do 4%. Excellent. And then ba-boom. I'll just keep it at 1. Copy this. Paste the formatting. We'll come back to deferred revenue later on. So now that we have our working capital and D&A schedules done, what we're going to do is start linking this to our balance sheet and cash flow statement. So first, we haven't linked anything really, so let's just do our cash, and this isn't going to be accurate quite yet because we haven't done the linkages in the cash flow statement, so don't worry about that. But this is just going to be linked to the bottom of our cash flow statement, our end of period cash. And then our accounts receivable, what is going to happen is we're going to take our end of period from the corresponding quarter or corresponding year, the corresponding period. And then we're going to do the same for really everything here. So our inventories, our prepaid expenses, our PP&E, we'll get to this later, but just one thing to note is we see 18 million here, we see about 3.8 million here, and 15 million here. The whole idea is this plus this should match this, as they are meant to offset each other. Our intangible assets, end of period. Goodwill, unless we are going to state that we are going to continue or to acquire, there's no need to have this increase further, as this is taking into account purchases or value above fair value of the assets being acquired in some sort of acquisition. Therefore, it's going to set this to the same as it was before. And other assets, we're going to come here and ba-bam. Same idea with our liabilities. It'll just be equivalent to the end of period. Nothing too special here. We're going to get to deferred revenue later. They do it in an odd way, but there's one thing I want to note. Oftentimes, when you're dealing with a SaaS company or companies that have subscription-based models, it'll be off of a yearly basis, and you'll be recognizing revenue over the trailing 12 months of when that revenue was brought in. With our business model, it's a little bit different, or with Napa, it's a little bit different, because deferred revenue is seemingly occurring over a 180-day time span. I'll have to double check that and we'll get to it later, but at the moment it's definitely different than your typical. But I do want to note you would have to build out a deferred revenue schedule for recognizing revenue over the trailing 12 months in equal parts, but we'll get to that later. And then current operating leases, we went into that a little bit earlier. Derivative instruments, we don't see much change or really this being recognized. It seemed to be an earlier thing back in 2021. I do not think it's going to be reinstated. Debt, we'll do this on a debt waterfall, and other current liabilities, we'll have to deal with that as it was modeled out on the cash flow statements, lumped together with your other current and non-current. We're going to have to separate that. So, yes. And then revolving line of credit, that'll be a revolver on our debt waterfall. Again, debt waterfall, went over this already. Derivative instruments, not seeing too much there at the moment. Deferred income tax, we'll have to get into that. Other liabilities, same thing with other current liabilities, it's lumped together. Common stock, it's going to stay the same unless we're going to have a secondary offering. And then additional paid-in capital we'll get into and tie things together at the end, as well as retained earnings and non-controlling interest. Now it's time for the cash flow statement, which is a little bit trickier, but still you have to think of everything in relation to cash. So we'll do an example in your C as we get into it. For inventories, if I am increasing the amount of inventories and I'm producing more inventories, that's going to be using cash. Therefore, my cash flow, my inventories will be going up, but my cash flow, I'm allocating cash to inventories, therefore it'll be a negative on my cash flow statement, while on the balance sheet, my inventories line item is going up or increasing. So before we get into that, let's do a little bit of linking. So our net income, right, that flows directly from our income statement right here. Deferred income tax seems to be recognized in the fourth quarter. We may have to touch on that, but I don't think it's too material. The return on invested brain cells seems negligible or very questionable. Depreciation and amortization, it's a non-cash expense, therefore we will be recognizing it as an addition to cash, even though we are depreciating an asset or an intangible, or a PP&E or an intangible for depreciation and amortization. So here we go, total D&A, positive. This seems like it occurs somewhat frequently, so we may have to model this in. However, I'm not sure how we're going to go about it. We'll have to look into the SEC filings, so we'll leave that blank for now, get into change in fair value of derivatives later, as well as amortization of debt issuance costs when we get into the debt waterfall. Loss on debt extinguishment, that seems like a one-off. We can't predict a one-off, therefore that along with impairment loss going to be 0. Stock-based compensation, we're going to have to come back to that later. Inventory reserve, again, seems to happen in the fourth quarter. Not sure how we would model it out. I may have to look into filings. Now let's get into the bones of this. So with an accounts receivable, the whole idea is if my accounts receivable balance is decreasing, that means I'm recognizing the cash that was in my accounts receivable. Therefore, it is an inflow of cash even though my accounts receivable decreases on the balance sheet. So we'll go to our working capital and D&A. Let's go up to our accounts receivable. And we see this is negative, right? So we are recognizing $23 million or $24 million of cash that was previously in accounts receivable. So what we have to do here is it is an inflow of cash, even though it was already recognized on the income statement from prior periods. Now let's get into our inventories. I brought up the example prior where your inventories are increasing, therefore it's an outflow of cash. So let's look back at our schedule here and realize that our inventories are decreasing. Therefore, it should be an inflow of cash. So just make this negative. Prepaid expenses and other assets. So what we see here is our prepaid expenses that is going up, so expenses that we have already paid for. So the whole idea here is that it's an outflow of cash. So what we're going to have to do is go over to our balance sheet. We'll go to our cash flow statement, and we'll go over to our balance sheet. And what we'll do is we'll take this and then subtract the other period because it's an outflow of cash. Other assets is going to be similar. So if we are seeing on our other assets, we're seeing that other assets is increasing, therefore we must have spent cash on other assets. So what we're going to have to do is take column T and subtract column U, giving us an outflow of $325,000. Now let's get into our liabilities. This is where it's going to flip-flop. So the whole idea of accounts payable is these are things that I owe money on that I've already received. However, I've yet to pay. So the whole idea is I have a credit card and I haven't actually paid out cash yet. So what we're going to do is we'll look at the historical manner of what we've done with accounts payable to hopefully help with the concept. So we saw that in quarter 4 our accounts payable went up $1.9 million. This means we have received the item, but we have yet to actually pay for it. So if my accounts payable is decreasing, that means I am now paying out this actual amount. Therefore, this negative $16 million, my accounts payable is going down as well as my cash balance is going down. You'll see this trend with all the liabilities, and your assets are the other direction. Accrued expenses, same idea here. What I'm going to do is take this and then subtract the past. So negative 28. So we can double check our work as well. So we can see that on our cash flow statement in Q4 we saw an increase in cash of $3.2 million from Q3. So let's go back to our balance sheet and see what happened here. So an increase in cash here of $3.2 million. Not sure why that's not perfectly accurate. There's probably a little bit of a difference here. But the whole idea is this is increasing, right? So this is increasing substantially. So now when we have an decrease in accrued expenses, this means we have spent cash. Accrued compensation. Take this and then subtract the past. Deferred revenue, we'll get into this later again. We'll leave a little red highlight here. This is just something I do just to make it a little bit easier for me to remember. Screw that up. And we also have to get into this later down the road, but same idea. So now let's get into purchases of PP&E, aka CapEx. So if I am buying in fiscal year 23, we saw the company spend $72 million on new PP&E. So the whole idea here is I lost $72 million of cash to purchase PP&E, and this is what we refer to as CapEx. So we have our beginning of period, end of period here. This is our CapEx. So we're going to have to make this negative. Business acquisitions, unless we're doing M&A activity, we'll keep it that. Alrighty, so that's what we're kind of at the moment. Dividend to parent. We'll keep that all like that. Payments under line of credit. This is all going to be debt waterfall. We'll keep this 0, 1 off. This will be at derivatives. Unless we're issuing debt, we won't have to model that out. We may have to do this in 2028 when they renew, and we can make some assumptions off of that. So we're making significant headway here. There are a few line items we still have to do, right? Primarily pertaining to the debt schedule, disposal of assets, not worth our time because it's $42,000. We may want to play around with that. But now we have our cash flow statement. I'm very curious about this. Oh, simply because we haven't. And there we have it. The next step is our debt waterfall or debt schedule. And what I will say is Napa's debt isn't the most typical. We aren't used to seeing this, especially if we've only dealt with our large cap companies. With our SMIDs or small slash mid caps, this is a lot more common to see these debt instruments. With our large caps, oftentimes you'll see a combination of bonds as well as a revolver, aka a corporate credit card. And with the emergence of PC and dealing with our mid cap type companies, because lending is becoming more competitive, we're seeing more cov-lite style bond agreements and bond contracts. So first, let's go over the three main types of credit agreements. Our first one is our bond. So you're going to be paying, it can be either floating or fixed. Oftentimes it is fixed. So that'll be based off of a spread. So that spread is because, and it'll be a spread to treasuries. So it'll be a spread based to take on the excess risk that is being taken on by investing in bonds for a company opposed to the US Treasury, which has never defaulted. And from there, what's going to happen is you will be paying out interest payments semi-annually until the maturity date, where you'll pay the final amount out to the bondholder. Our second one is our revolving line of credit, which is our most liquid instrument, and this acts like a corporate credit card, and it provides instant liquidity for companies to draw down when it's necessary, when they need to. In this case, it'll be based off of a spread of LIBOR or SOFR. It used to be LIBOR more often, and now we have transitioned over the last year to SOFR, which is secured overnight funding rate. So we'll see a SOFR plus XYZ bips. In this case, our revolving line of credit is SOFR plus 150 to 100 or 100 to 150 bips, depending on the average availability of line, and we'll get into that later. And our third one is a term loan. So a term loan is you're given a certain amount of facility, and then you're going to be paying back principal payments along the way. However, you have the ability to pay back in advance or pay back the complete amount at an earlier date than maturity. We refer to this as a cash sweep. So it allows, if a company is paying back earlier than to maturity, they're going to avoid some of that interest rate or interest expense over the duration. So oftentimes when a company has excess cash, they'll allocate it towards paying off their term loans and that amortization. So now looking more at Napa, let's take a look at the debt that they hold. So back in, I believe, November of 2022, they entered a new debt agreement facility for a total of, for a total of 675.8 million in first lien senior secured credit facilities. And there were three different types of credit agreements in this. We saw a revolver, which allows Napa to draw down up to $425 million, as well as you have an additional amount for seasonality, which is $30 million of capacity. And all of these three agreements that we're going to be speaking of has a maturity date of November 4th, 2027. And the interest rate is a range of SOFR, which is currently at, I believe, 5.3, plus your 100 to 150 basis points. So this is based off of the average availability. And just for simplicity's stance, we won't, and because it's not super material, and the return on invested brain cells would be would be horrible. We're going to give it an average or give it the highest level. So we can see that based off of our revolver, our average level, if we have less than 33% available, is going to be 1.5%, SOFR plus 1.5% or 150 bips. And then if you have, say, greater than 66% of your revolver not pulled down, then it'll only be 100 bips or 1%. And we see this for in our 10K and in our SEC filings, we see other notes on this as well. Now let's get into our term loans. So our term loans are $225.8 million. And the whole idea here is the term loan is going to have an interest rate of SOFR plus anywhere between 10 to 15 bips. And we should note that this revolving line of credit, it's super liquid, and the company can draw down upon it if they aren't violating any of the covenants. They can draw down upon it on any point of time, up to $425 million. Therefore, it's going to be more expensive to borrow. So if possible, the company does not want to utilize their revolver. They want to utilize the cash that they are getting from other credit facilities. So let's get into our term loan. So the term loan, like I stated earlier, $225.8 million with a interest rate of SOFR plus 10 to 15 bips. And then we have a delayed draw term loan, which has a maximum non-revolving drawdown limit of $25 million with quarterly principal payments as well on top of that. So to kind of enter all of this data in and have it be able to easily reference to, I'm going to create a cap stack, a capital structure. So what we're going to do here is first do a cap stack. So the whole idea of a cap stack is it gives me the idea of the bonds and what exactly they are. So here I'll do what type of credit facility it is, and then I'll do the amount, the coupon / rate that we are paying, the maturity date, as well as any notes. And oftentimes here, when I'm dealing especially with bonds, what I'll do is I'll do X or how many times through last 12 months EBITDA, as well as cash flow, to get a better idea of the ratios. And whole idea is if I am 5x trailing 12 months EBITDA, it would take me 5 years of EBITDA to fully pay back this amount that this bond is credit facility allows. So I'll make this larger, or I'll take this. Doesn't look quite right. Maybe it was. It's going to be like that. So our first credit facility is, we have to remember that these often has different tranches as well when we're dealing with other companies. In this case, it is a singular credit facility that is broken down into 3 different types of debt instruments. And these are all first lien senior secured instruments. From here, let's get into what they are. So first one is a revolving credit facility. Our second one is our term loan. And then third one is our delayed draw term loan. Now the amount here, our revolver, allows us to pull down 425 million, so 425. Our term loan is 225.8. And then our delayed draw term loan is, I believe, 25. Let me double check. 25. And then for our coupon / rate, in this case it would be rate, so I'll just change this quickly. For our rate, we would have, on our revolving credit facility, we would have tiered. In this case, we'll take the tier 1 or tier 3, which is 100 bips, just because I doubt that they're going to have to draw down on any more than 33% of the availability. So this will be 100. Our term loan is we'll do 15 just for this case, or we can take the average of 12.5, and then our delayed is the same. Let's make these into a custom format, just have a number, or just do SOFR plus, and then excellent. For our maturity date, all of these are November 4th, 2027, 11/4. And then let's take some quick notes on these to get a better idea of how they work. Make that significantly wider. I still believe this is a little bit off. I'm not sure why. That looks much better now. Okay, so general notes on our revolving line, 425 million with an interest and rate of SOFR plus 100 to 150 bips, depending on availability. Then from there we have to look at, oftentimes to have this revolver in general, a company will have to pay a fee on the unused revolver. So in this case, I believe the fee was 0.15%. So we refer to this as a commitment fee. Commitment fee of 0.15%. So basically, if I have $0 of this revolver drawn down, that means I have 425 million available, and I'll be on an annual basis, I will be asked to pay 0.15% on this revolving credit facility just for having it and having that flexibility. And as of October 31st, so Q1 of 2024, as of Q1 24 had 23 million drawn down. Now, let's get into our term loan. So this is 225.8 million with an interest of SOFR plus 10 to 15 tips depending on period. And oftentimes your term loans will not have a commitment fee. As of Q1 24, had 218.3 million left. This will be 25 million. Excellent. Trying to find if I put this. Oh, there they are. We'll delete these in a second because we won't need them. And the unused line fee, we have to note that too. Unused line fee of 0.15% on this as well. Excellent. Already, and then that. Excellent. So there's our cap stack. Oftentimes it'll be much longer than that. Oftentimes it'll be much longer than that because we're going to have multiple tranches of debt. However, in this case, it is all under one facility. And we'll leave a little note here. We'll leave a little note here stating that entered agreement, and this is from the 10K, I'm just looking at my other screen. Entered agreement on November 4th, 2022. The agreement provides 675.8 million in first lien senior secured facilities. Excellent. Alrighty, now that we have this, we don't really need this anymore. Excellent, and now let's get into building this out. So first of all, what we want to do is, because we are referencing SOFR, we want to figure out what our SOFR is going to be and what we are projecting SOFR to be. So at the moment, it is, we'll do this. And I have to make this to a percentage. Where is it? There it is. We're going to have to hard code this so we can consistently reference it because SOFR does change. Now, with that being said, it does trade, SOFR, the rate is very similar to our federal funds rate. So what I'm going to do here is, so currently our federal funds rate, our effective federal funds rate is 5.33, and then our SOFR rate, I believe, is 5.31. So here's the most recent dot plot, and they move in very similar ways. Therefore, I'm going to be using this here, and we'll just screenshot it and use this here briefly. So currently we're at 5.31, and in 2024 the majority of people are expecting it to be 4.75, and then in 2025 we see the majority at 3.25. Oh. 3.25, and then in 2026 it is more scattered. However, we'll just play it safe and go with 3%, and then long term at 2.5, and that is off our federal funds rate. So now we have our SOFR that we'll be able to reference throughout this entire model. And from there we also need to understand, especially, we're first going to do a revolver because it's the most liquid and we're going to put it at the top. So for a revolver, how this is going to work is we need to understand we're only going to draw down the revolver if we have liquidity issues and don't have the ability to either pay back interest rates or interest payments or general operations for a company. And remember that our revolving credit facility or revolver is sitting around 100 bips. And oftentimes companies will have a minimum cash balance as well. We'll get to this as we go, but the whole idea here is we don't want to draw down upon the revolver unless we really need to. So revolver needs analysis. We're going to do here. That, and then so our first thing we want to look at is the amount of cash we have at the beginning of period. So BOP cash, and then we also want to understand the minimum cash balance that the company likes to keep on hold. Sometimes they state it, and sometimes it's also necessary for the credit agreement. However, it is not stated in regards to Napa. Therefore, we'll either have to kind of wing it or set it to 0, which is probably more likely what we're going to do. And then we, from there, want to figure out the current cash flows or the current period cash flows without the revolver. And then from there, we're going to have the cash available, or in parentheses, needed to pay down or draw down. Sweet, so our beginning period of cash, what we're going to do here, and we're keeping these two open because we're going to need to utilize them as reference points as we move down, you'll see. So keep 2 columns open before you get into your dates here. So our beginning of period cash here, we don't really need to do it for our Q1 2024. However, what we're going to do is understand the cash available or needed to pay/draw down. And also we want our beginning of period cash, right? So what we're going to do is simply pull this from our balance sheet, right? So in Q2 2024, or sorry, in Q1 2024, we had roughly about 21 million of cash, right? So that's our beginning period of cash for fiscal year 2024. And then when it comes to our minimum cash balance, what we wanted to do here is this is going to be our minimum cash balance that we want to have. In this case, I'll just put it at 0%. We can put it at 5% just to demonstrate it for you. So this is as a percentage of revenue. So typically it may be done as, say, 2% of revenue you want to have as a minimum cash balance. However, they didn't state it in their SEC filings. So here what we want to do is take our minimum cash balance and multiply it by the period's revenue. And let me fix this. Oh, I pressed the wrong button. fix this. Oh. I did it again. Fix this, and then control right. Let's get our x's over here just for ease. And then from here, this will just be control right here, and then want to make that. And this is where things may seem to get a little bit tricky. But what we're going to do is we're literally going to take our cash flows from that period and then just not including the revolver. So in this case, let's go to, we'll do this as a sum. So fiscal year 2024, right, we saw our net cash flow provided by operating activities. And then we used 37 million, or projected that they're going to use 37 million for purchase of PP&E. And then from there, we want to look at the everything literally but the revolver. So under line of credit. See right here, your borrowings from line of credit. So 23 million like they stated. So from here, it'll just be everything down. Close that. And that'll give us that number, control right, and go down. So in this case, we had a minimum cash balance, so if we put this to 0, right, they don't need any cash on hand, but let's do it as 2% right now. So equals this minus this plus this. Right, so you see that they have plenty of cash at the moment on hand, and we haven't modeled it out throughout the entire thing. However, this is just a good idea of it right now. And if we go to 0 here, right, that gives us this. Right, cash needed or available to pay down. So if this number is negative, that means we would need to pull down on a revolver to meet cash requirements or liquidity. Now let's get into our revolver. So with our revolver, the first thing we want to do is our beginning of period balance, and then our drawdown slash paydown, or we can just do drawdown. And then our end of period balance. And then from there, we're going to have our interest expense, our amount undrawn, because remember we are being or paying out a 0.15% of the amount that is undrawn for having this credit facility open. So that's that amount, and then our commitment fee, which is that 0.15, and then from there we'll get our total interest. Excellent. So our beginning of period balance, we know what it is going to be, right? When you are referencing our cash flow statement, we're seeing that our borrowings from line of credit, our line of credit is our revolver, is 23 million. So we'll do that linkage. And then we'll get to this formula here in a second. Our interest expense, so we're going to put the rate here. So it's a little bit simpler. We're going to put the interest rate here, so this is going to equal this amount over here, and we'll copy the formatting. Then here we're going to have the amount undrawn. We'll put that over here. And then the commitment fee as well. So our commitment fee, remember, is 0.15%. So turn this into percent. Excellent. So just a quick recap. We're taking the SOFR from our inputted information on our cap stack over here. Our beginning balance is the amount that we have drawn down from our balance sheet, and the amount of drawdown. This is going to be the tricky equation that really is going to make it flow, and our end of period balance will just be this minus this.